Is it much more difficult getting stocks right now? I think that is the basic nature of investing. When you want to go out and buy, things are not cheap. When you are feeling scared and want to invest in fixed deposit, that is exactly the time when things are cheap. So I think what's interesting for me and what stands out for India, and we wrote a piece about it called The Joy of Rowing Downstream, is that India offers a unique combination of growth and acceleration.
Good afternoon, you're watching Bloomberg Quint Live. I'm Alex Matthew and these are the headlines. Markets continue to consolidate. The Nifty hovers near the 10,200 mark. IT players weigh while auto companies extend support. Bharti Airtel sells 4.5% stake in Bharti Infratel at 400 rupees a share. Sun Pharma, Eicher Motors and GAIL are the three Nifty earnings of the day. Kadam India lists at a discount of 20 rupees to its issue price of 750 on the National Stock Exchange. And finally, Gujarat Chief Minister Vijay Rupani tells Bloomberg Quint that he's confident that the BJP will win more than 150 seats in the upcoming assembly polls. And now it's over to Darshan Mehta for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business. This is a show which gets you a complete. Joining us on the show today is Umesh Mehta of Samco Securities, independent market expert Dharmesh Khan, and T.S. Harihar of HRBV Client Solutions. Today on Hot Money, we will discuss stocks like Britannia, Adani Ports, M&M Financial, Vakrangee, and Suzlon. Okay, before we move on to the first stock, Cadila numbers are out. It's the second largest pharma company in India by market cap. Numbers at this point of time look pretty much above what the street was anticipating, what we were anticipating. Revenues have come in at 3230 crores. Our estimate was 3225 crores, trading at the highest point of the day. EBITDA coming in at 850 crores versus our estimate of 760. And profit beat 503 crores versus our estimate of 484 crores. So these are the details that we have. On the face of it, it looks like it's a strong number from Cadila, so the counter pretty much trading near the day's high. But let's move on to Hot Money. The first stock that we'll talk about is Britannia. Big news coming in the morning, the MSCI inclusion that has happened in the large cap. Let's talk about what it does. One of the best return ratios on the companies, ROA of 25%, ROE, ROC of 36%. But an expensive stock, what should one do? Should they continue with growth or should they look at value? Britannia, let's talk to our guest first. Hari, I'll start with you. What's your view on Britannia?
See, I think the latest results continue to be impressive. I think about 11.5% growth in profits is a good number for a company of that size. But I think what is probably more important and the key indication that we got in the last quarter is that the post-GST pain seems to be over, which means the company seems to be kind of bottoming out, after the pain of demonetization, after the pain of GST. I think companies' numbers seem to be bottoming out. And again, if you look at the niche, which I call the slightly upper market biscuit segment, they have a virtual monopoly in that. There are others in the mid market, in the entry market, but in the niche biscuit market, Britannia has a virtual monopoly, and that is an area where they have the highest margin. So I think that probably explains why the ROE and the ROC of this company is so high. So expensive, yes, but tell me one FMCG stock that is not expensive. So I think that may not be a real argument against it. I think if you're looking at the Indian consumer story, I would believe that Britannia seems to be a very good play for the next 1 or 2 years.
Okay, Dharmesh, PE of 57 times trailing, almost 47 times next year. Are you happy with this valuation or do you think that it's expensive?
To my mind, it's an expensive stock because what best you can get from Britannia is around 12 to 15% kind of a compounding on the earnings. Not beyond that too in the best of the scenario. Input prices will be firming up and as the competition is heightening up because of Patanjali and the likes. So you need to spend more on the ad expenses and all. So to my mind, for a portfolio buy, like if you have a structured portfolio where you need to be invested in FMCG, a small portion to Britannia is, that's fine.
No, but if not Britannia, what else in the FMCG space? Because they are in a niche play. They are only focusing on that biscuit segment, on that eatable segment. But apart from it, and it's outperformed HUL or ITC. So right. If you want to play that, ITC becomes a much more diverse play. HUL also becomes. So if not Britannia, what should you play in the FMCG space? The valuation is expensive, no doubt.
Yeah, see, To my mind, in the present market scenario, in the environment in which we are, FMCG should be avoided because that won't give you the delta or alpha which we are looking forward from this market, the growth trajectory in which we are, there. So just for 10-15% kind of an annualized return, Britannia can be there. But if you really want to have a valuation gap catch-up kind of a play, ITC looks to be the best bet in that segment.
Okay, before we move, the WPI numbers are out 3.59 versus the estimate of 3%. So the WPI number is much higher than what the Bloomberg estimate was. So that's what we'll keep on getting more details on that. But Umesh, your view on Britannia?
From business perspective, I think it's a great business model. But as an investor, how I am going to make money? The stock is richly priced. See, the habit of market is to extrapolate, and the way company has delivered growth, and therefore they are extrapolating that the same amount of growth and margin expansion will continue. But that may not be the case because competition is increasing. But the one good thing about Britannia is, see, people like taste. So if I like a biscuit, I'm going to keep on repeating. But at the same time, people don't have that much affinity for a shampoo. I will change shampoos or soaps, but I will not change my eating habits. So to that extent, yes, Britannia has a lot of stickability, and we have seen, how they have slowly and steadily penetrated and expanded their margin. But all said and done, from an investor's perspective, it's a good stock, but wait for correction. This isn't the time to invest because ultimately their portfolio will then underperform. So that's how we see. Long term, yes, we are super bullish on the stock. Given that the brands that they have, they will surely be able to scale it up, leverage. They will be able to capture untapped potential, which there is huge. But in the short term, I think the stock is really overvalued and it has to get corrected.
Okay, so that's the view that's coming in on Britannia. It's moved up 57% in the past 1 year. Hari is rather bullish on Britannia. Other two guests, Dharmesh does believe that FMCG as a pack should be avoided. Britannia is expensive. Umesh also says for a long-term perspective, yes, Britannia is something that you should buy, but not something for the short-term. Valuations are too expensive. Let's move on to the next stock, and that is Adani Ports. The numbers that came in yesterday were pretty strong for the company. The revenues were up almost 25%, margins of 66%, profit came in, was down 6-7%, but much ahead of what the street was anticipating. Is Adani the best play as far as the infrastructure port is concerned, market is concerned? Let's ask our guest, Dharmesh, any view on Adani Ports?
Yeah, it's one of the best play as far as infrastructure and logistic play is concerned. Primarily ports, the numbers were excellent. What happened with Adani Port is because Mudra coming out of the SEZ, the taxation was there. This is an optical because cash flow impact is not there because they are already having a 2,700 crores of MAT credit into their books. So that would be offsetting the cash flow. Going forward, the type of trajectory they have embarked on and the type of port connectivities, all the ports they have from West Coast to East Coast. I expect 25 to 30% kind of a CAGR on revenue. Okay. From FY19 onwards, you will have that delta coming into the bottom line as well, as far as the PAT is concerned, because this will be a base year where you have the taxation liability in place, and then you will have the compounding of earnings taking into play. So to that extent, it's still not very expensive. So 20% kind of a compounding for the 5 to 7 years, if you see, it's easily a multi-bagger to my mind. So logistic play, make in India theme, everything working in favor, and we have seen that in the Adani Port numbers.
Okay.
So it's a must portfolio buy.
It's a portfolio buy. What about you? Do you agree, Umesh?
Let me recollect when Warren Buffett in 2009 bought Burlington Northern. He said that people will require goods and transportation is a must. Goods cannot be transported on the internet or in the digital platform. So, and when he bought Burlington Northern, that was at around 1 year forward, 18 times earnings. So coming to Adani Port, yes, we will require ports, and so this business is there for next 10 years. The major part currently is coming from Mundra. 67% of volume is coming from Mundra port, and balance 33% is coming from 9 different ports that are across India. So the biggest trigger that we see, going forward is Sagar Mala. When government's mission is to get connected through ports. So that is where we see incremental growth coming. But as the company is growing in size, the incremental growth that we are going to see, that will slowly decrease, and therefore we see the premium that the company is enjoying currently will slowly come down. So yes, long term I think it's a great stock, but in the medium term one should wait for 10-15 correction and then make an entry. So this will be a typical, compounder stock for next 5 to 10 years, and nothing is going to disrupt this model.
Okay. What about you? Do you have any view on Adani Ports? What's your view, Hari?
We are broadly neutral. I think a couple of reasons. I broadly agree with my two friends that if you look at the PLZ space, which is ports, logistics and SEZs, it's probably, I would say, the only play that's a true national play. I don't think there's anybody else in that space. Our concern on this stock is twofold. The first, of course, is that revenue growth. Yes, I think we also believe it's going to happen, but I think profits are going to take a hit. I think even this time we saw profits actually fell, and we expect the pressure on margins to continue. Second, how much ever we refuse to accept it, let's admit it that the stock is a politically sensitive stock. Yes. And you don't know what's going to happen in 2019. It's still an open and shut case, so we don't know what it is. If God forbid, let's say a change in government happens, what happens with this stock? Because the stock has largely, I think, had a good ride on the back of very good political support. So I think if the political equations change, what is going to happen to the stock is as of now not certain. So I think at these prices, to me, it looks to be fairly priced. We are neutral. I don't think we have a buy view at this price. We are not selling it because the momentum is in favor of this stock, but we are broadly neutral on the stock.
Okay, Dharmesh, valid concerns. I wouldn't want to comment on the political side because you don't know what can happen there. But on the earnings front, would you want to respond? Because he believes that earnings slowdown can probably come in.
So there is no earnings slowdown. What you have seen in the PAT slowdown was because of the taxation which played out. And that too 2 years of PAT profitability. I mean the tax liability which will be there on this kind of earnings is already taken care of.
Okay.
And then the asset sweating and everything will play out. So I don't think there has been actually earnings slowdown. Earnings are there in place. You are getting a earnings growth. At PBT level, you have 20% earnings growth.
Okay.
So that answers, your question.
Okay, so that's the view that's coming in on Adani Ports. Dharmesh is extremely bullish. He believes that Adani Ports can be a multi-bagger. Umesh also believes that it's a long-term compounding story. But Hari here believes that, at this point of time, not a sell, but, not something that at these valuations he would go out and buy. The next stock that we'll talk about is M&M Financial. It's been a good year for M&M Financial. If you're looking at the year itself, it's up almost 60%. Is the recovery real? Is there something that is happening on the street, on the ground situation that can actually help recover M&M Financial? Would you stick to M&M Financial, or would you shift to someone which is cheaper, like a Shriram Transport Finance? I'll ask our guest. I'll start with you, Umesh. Any view on M&M Financial?
To begin with, sell.
Okay.
M&M Financial has deteriorated on operating parameters since last 4 years, and that is a continuous trend. Cost to income ratio has increased from 33 to 43%. Gross GNPA has increased from 4 to 9%. NPA has increased from 2 to 3.6%. So this is just like any other PSU bank, wherein you have a gross NPA of 9% and the stock is trading at 3.5 times price to book. So might as well, why not shift to PSU banks, wherein there is a government behind to kickstart the whole process. So all that said and done, the stock has really gone up. As you said, 60% the stock price has risen in back of, it's like a laggard, when all NBFCs have gone up, so even this stock has also gone up. But fundamentally, we think there is something structurally, currently, the stock is not poised. If there is a continuous trend, deterioration, something that is really wrong with the setup. So we are bearish on M&M Financials.
Okay, what about you? Do you agree with his view, Hari?
No, we have a counter view. We actually like M&M Financials. And I totally agree with Umesh when he talks about the GNPS. I think GNPS is a big worry. I think it's 9.5 to 10% is the range at which the GNPS are. But I think it's largely provided for. I think roughly about 70% of the GNPS are provided for. See, there are two things I'm looking at in favor of M&M Financial. The first is, of course, that the NPS cycle, we believe that the worst is over, and we could see a bottoming out of the NPS cycle.
Okay.
We could remain at this level for about a couple of quarters, but I think we are bottoming out. The big trigger, I think, is something else. See, the entire rural portfolio was actually split between M&M Financials and other guys like the MFIs. You have the Satin Creditcares or the Bharat Financials. What has happened in the last 1 year after demonetization is that these MFIs have taken a real hit. And that is evident in the stock price, that is evident on their performance. They are not able to get out of that, the kind of crunch that they got into post-demonetization. So I think it offers a huge opportunity for M&M Finance to expand their rural portfolio. So we believe that M&M Finance, ironically, could be a big beneficiary of this downside that MFIs are facing. And I think that should hold the stock in good shape. So we actually like the stock. I totally agree on the GNPA front, but I think it's largely provided for. The NPA cycle is bottoming out. But more importantly, I think the MFI space is opening up for M&M Finance.
Okay, so one bullish view, one bearish view. What's your view?
Yeah, I'm neutral to bearish on M&M Financials.
Neutral to bearish, okay.
Yeah, neutral to bearish. The reason being, see, last 5 quarters we have seen 13 to 14% kind of a AUM growth. But what does M&M Financial do? It primarily finances tractors, SMEs, and pre-owned vehicles kind of a stuff. And see, any financial business where the promoter's main business is not finance should be avoided, because the size which at M&M is operating, it's an ancillary business to them. So the focus was not there.
Okay.
GNPA is actually 12.5% based on 90 days provisioning, which they have done, and net NPA is 6.5%. It's trading at more than 3 times the price to book. So the business of MFIs is totally different from what M&M Financial is doing. So it's an NBFC play on tractors, SME kind of financing, and 3 years of good monsoon, still you have such kind of an NPA into your books. So I would rather stay away at this valuation. If I have to play financials, there are plenty of other value-wise available in the market where the core business is financing.
Okay.
So that would be my choice of making an investment.
Okay, so that's the view that's coming in on M&M Financial. Hari is bullish. He believes that the sector has bottomed out and the stock has bottomed out. But that's not the view that Umesh said. He believes it's a sell at this point of time. Dharmesh also believes that, better plays rather than M&M Financial. Let's move on to the next stock, and that is Vakrangee, a marked outperformer. Surprising the market cap, almost 35,000 crores. It's as big as Lupin now. It's included the MSCI Global Standard Index. What's the view for Vakrangee? I'll start with you, Dharmesh. Vakrangee, any view?
I have a bullish view on Vakrangee.
Okay.
The way they have shaped up their businesses in a much better way. If you look at the last 10 years, it's a 10x kind of a revenue growth, 10x kind of a profitability growth. So it's a debt-free company. And see, they have tapped the untapped market. Primarily into areas where Government of India was fixing. Digitization has played a big way. White level ATMs with RBI they have tied up, and they are catering to rural areas. It's a service kind of a business which they are doing. Earlier, Sarv Shiksha Abhiyan and election card, UI.
They got out of the legacy business. Basically.
Yeah. So which was holding them back. They have moved out. And see, e-governance is still not even 5% of our top line. And that's will pick up in a big way. And this business has a big moat. You just cannot go and get a government order immediately. So they have already established a track record, and numbers are there. 50% kind of this half year growth in top line as well as bottom line. It's expensive. It's trading above 66 kind of a PE on a TTM basis. So that is there. But the type of ROEs it is having, the asset sweating they are doing, is the model which they have adopted. It's a franchisee-based model where they only invest in infra, training, and the software. The balance operating expenses is borne by the franchisee, which is out there. So the entire model is very nicely worked out. The team is management team is good. I mean, most of the people miss that on the street. But I do expect the type of earnings, 10-11 rupees was the FY17 EPS, and 20-25% of compounding will take it to 20% soon. So still plenty of room there. A good buy.
Do you agree, Umesh?
Yes, this is a new age business model, and digital leveraging and capturing the unpenetrated Indian hinterland. I think all those factors this Vakrangee is really capturing. So I'll give you a perspective. If Avenue Supermarket is trading at around 117 PE multiple, and they are also a mall catering to goods, Vakrangee is also a sort of mall selling services, financial services, providing all those services on digital platform. They have really based a good amount of market based on trust, and they have track record. And I think company is doing great in terms of the potential that they are into, and they are going to double the size in next 3 years. So such kind of business model I think are rarely available, and many have really ignored because of past legacy issues of Vakrangee. But I think things have changed. And even currently, the stock is traded at fairly valued. We believe considering the growth, the return, the ratios, and the efficiency, I think it is worth investing for long term.
Okay, what about you? Very quickly on Vakrangee. 2 thumbs up. What's your view?
Interesting thumbs up from my side too. See, I'll just put things in perspective. I think last year India sold about $40 billion worth of goods on the e-commerce platform, and Jackie Ma sold $45 billion in one day. So that probably shows you the difference between what India is doing on e-commerce and what China is doing, and it also shows you what is the untapped potential as far as India is concerned. Now, I think Vakrangee, while it may not exactly be an e-commerce company, it's a facilitator. So it's into rural. It's doing a bit of what MFI is doing. It is doing last mile delivery. In fact, last mile delivery is their big advantage. So I think it's kind of a humongous growth model. I admit that in the last 2 years they've actually given away a little bit on their margins. If you look at the margins, it's down about 400 basis points. But I think they are actually buying growth, which I think is a very good strategy for this kind of a business. They are buying growth, and we like the stock a lot. In fact, for us, it's hard to set a target, but I think it could be a huge number in the next 2 or 3 years.
Okay, so that's the consensus view that we are getting in on Vakrangee. It's a triple thumbs up. And moving on to the final stock, we have a guest waiting actually, so we'll have to rush through Suzlon. The numbers are very weak. What should one do with Suzlon? I'll start with you, Hari, very fast. We have a management waiting, so a minute tops on Suzlon.
We are negative because we are negative on the entire with oil at about $60-65. I think it's at a level where the investments in alternate energy are going to go down.
Achha.
So I think Suzlon, unfortunately, due to its huge debt 10 years back, has missed out on the best phase between 2009 and 2017. They have missed out that phase, and I think it's going to be very hard for Suzlon to do anything worthwhile from here. So we are negative on this.
Okay, what about you, Dharmesh? Suzlon?
Negative on the stock, primarily because wind energy is not a viable option because of geographical concern, eco concern, and the type, everything put into place. So better avoid.
Okay, what about you, Umesh?
So I'll quote from Warren Buffett: "Turnaround seldom turns," and people betting on Suzlon that it will turn around someday. And if that same energy is applied in investing in great businesses, I think a larger money can be made. So said and done, I think some structure is weak in terms of the wind energy space that they are operating into. So I think to cut the argument short, we are bearish not to invest.
Okay, so that's the consensus view. Again, when Vakrangee, everyone was a positive. It's a consensus negative view that's coming in on Suzlon. Hari, Dharmesh and Umesh, thank you so much for coming on the show and speaking to us. We have a management waiting. Satin Creditcare reported a steady quarter in September. To help us decode the earnings in further detail and to discuss the road ahead for the company, joining us on the show right now is the CMD of the company, Mr. H.P. Singh. Mr. Singh, thank you so much for speaking to Bloomberg Quint. If you're looking, can you just take us through the broad contours of the number? What kind of growth are you seeing in your loan book, and what about the credit cost for the company?
So for us, I think after the June quarter loss and the March quarter loss, I think this is probably a turnaround where we've posted 13 crore PAT, technically standalone basis in this space, and having probably turned around the corner. I think the blues for demonetization for us are practically over. In spite of the fact, I think we've probably been impacted the most amongst all our peers across this thing. And so we've done an analysis as such where we were impacted about 70% in the territories as compared to the industry, which was about 30%. So for us, it's been a good quarter for us to look at. And in terms of our loan growth, I think the levels of disbursement now have practically picked up to the levels which were there pre-demonetization level, and we've done close to about 1,200 crores in this quarter as compared to about 1,100 crores in the previous quarter. So I think the loan growth and everything is on course, on target for our guidance for March 18, which is about 5,500 crores.
Mr. Singh, how is the collection trend in key states that you operate in, UP, MP and Bihar? Also, you've started operations in Orissa this quarter. What's the situation there?
So for us, last 5 months on all these states across where demonetization was the biggest impact which we have faced, we have 100% plus collection efficiency. In fact, if I give you a number for standalone September, we have 106% collection efficiency in all these states put together. And it's been consistent for the last 5 months, which means the areas are now coming in across in all these states for the last 5 months or so. And in terms of our expansion into states like Orissa and everything, I think Orissa has probably been a very good state for the microfinance industry as such. And we've taken our steps to move into these states, Orissa, including Northeast as well as West Bengal. So these are our newer states, where we are concentrating now to increase our loan book.
Can you give us an indication of the cumulative collection efficiency post demonetization that has happened till date?
Cumulative, so that's where the cumulative efficiency, I think it's close to about, if I put together since demonetization, it will be close to about 94% as such,
Okay, what's your outlook on growth and disbursement number for the quarter? Has it returned again back to pre-demonetization levels?
Yeah, it has, so that's what I said, for us, this quarter was probably also on the basis of disbursements, a better quarter than what the previous quarter was. And looking at the way things are panning out to be for microfinance across, all these states over here, with small finance bank, probably, I wouldn't say vacating the space, but I think taking somewhere a cue to move slightly away from the microfinance space gives us people like us to probably look at microfinance in a larger perspective. And I think, for us, probably growth is now going to be a key driver, for our quarters ahead.
Can you also share some details on the asset quality performance and your guidance on the cost to income going ahead?
So our cost to income has in fact dropped from the previous quarter to about 53% from a 68%. So I think there is going to be improvement in this thing over there. The cost to income ratio. But in terms of our credit cost, I think our gross NPAs have moved down from about 14.66% to about 11.3%. And our net NPAs are down again from 10% to about 6%. And moving ahead in these further quarters, I think this is going to go down from there on.
Okay, and my final question, Mr. Singh, is the company really raised nearly almost 500 crores in the last 1 year. How much fund is still needed, and do you have any more fundraising plans that the company has?
I think for us, what we are now looking at is growth capital. Our capital adequacy remains pretty good. It is at about 25% or so post the QIP, which we've done in about a month back. For us, the only need for us is more growth in microfinance, as well as for us our diversification into SME, as well as we're waiting for our license to come in the housing finance, affordable housing finance space. So for us, whatever capital is going to come in across is going to be needed for whatever growth happens in microfinance as such, for SME as such, and for housing finance as such. So for us, we definitely would require capital, but as and when it is required, we'll definitely will be bringing it in.
Okay, Mr. Singh, we'll leave it at that. Thank you so much, sir, for speaking to Bloomberg Quint, and all the best for the quarters going ahead.
Thank you.
Okay. With that, it's a wrap on today's Hot Money. But up next, I caught up with the management of Aarti Drugs on their second quarter earnings. We'll get your slice of that conversation in just a bit.